Welcome to the Retirement Wealth Podcast, where we help you navigate the journey toward a fulfilling retirement. I'm so glad you're joining us for this episode, because today we're diving into something really important: tax-efficient withdrawal strategies.
Absolutely, Emily. It's a topic that doesn't always get the attention it deserves, but it can have a huge impact on your retirement income and overall financial health.
Right? I mean, it's not just about how much you save, but also about how you take that money out when the time comes.
Exactly. We'll be discussing the different types of accounts you might be withdrawing from, the tax implications of each, and some strategies to minimize your tax burden.
Plus, we'll touch on how to balance withdrawals to ensure you have enough income throughout your retirement without running into tax issues.
And let's not forget about Social Security. Knowing when to claim it can also tie into your overall strategy.
Yes, so many factors come into play. And for those who might feel a bit overwhelmed, we'll break it down into manageable steps.
That's the goal, to empower listeners with knowledge so they can make informed decisions.
So whether you're just starting to think about your retirement plan or you're already in the thick of it, we've got some valuable insights coming your way.
Let's jump right in. You know, Emily, when we think about tax-efficient withdrawal strategies, it's really crucial for folks to understand why this is so important right now. I mean, we're living in a time where the economic landscape is shifting so rapidly.
Absolutely, David. It seems like every day there's a new headline about inflation or market fluctuations. It can be really overwhelming for people planning their retirement, right?
Exactly. For many, retirement timelines are shifting. A lot of people are realizing they might need to retire earlier than they planned due to job changes or health reasons. And when that happens, having a solid withdrawal strategy becomes vital.
Right. And if they're not careful, they could end up depleting their savings much faster than they anticipated. I remember talking to a couple. Let's call them Tom and Linda. They had a nice nest egg saved up, but they were so focused on enjoying their retirement that they didn't think about the tax implications of their withdrawals.
That's a great point. Tom and Linda were taking money out of their 401k without considering how it would affect their tax bracket. Suddenly, they found themselves in a higher tax bracket, and it really cut into their income.
Yikes! That's a tough lesson to learn after the fact. So it's really about being proactive, isn't it?
Totally. And with inflation being such a concern right now, it's even more critical. The cost of living is rising, and many retirees are feeling that pinch. If they're not strategically withdrawing their funds, they could find their purchasing power eroded more quickly than they realize.
I think that's a huge fear for a lot of retirees, losing the ability to maintain their lifestyle. And let's not forget about market volatility. It's been a wild ride lately.
Absolutely. With the stock market's ups and downs, retirees need to be cautious about how they're pulling money from their investments. For instance, if someone is withdrawing from their portfolio during a market downturn, they could lock in losses and diminish their long-term growth potential.
That's a really important point. So, what would you say to someone who's worried about balancing withdrawals while also trying to keep their money growing?
Well, I'd suggest looking into a diversified withdrawal strategy. It could involve taking some money from taxable accounts first, letting the tax-deferred accounts continue to grow, especially in a volatile market. This way, they're not forced to sell investments at a loss.
That makes sense. And there's also the whole Social Security aspect to consider, right? With changes happening there, it's important for retirees to think about when to start taking benefits.
Definitely. The timing of Social Security can have a massive impact on your overall retirement income. If you start taking it too early, you could end up missing out on thousands of dollars over your lifetime.
Wow, that's a lot to consider. It's like a balancing act, really?
Exactly. And then we have healthcare costs, which are rising, as we know. It's essential for retirees to factor in those potential expenses when planning their withdrawals.
Yes. I've heard so many stories of retirees being blindsided by medical expenses. They thought they had enough saved, but those unexpected costs can really take a toll.
It's all about being realistic. There's a gentleman, let's call him Jim, who thought he was well prepared, but when he hit a health snag, those costs started piling up. He had to adjust his withdrawal strategy on the fly, which wasn't easy.
That's a tough situation to be in. So what about legacy planning? I know that's on a lot of people's minds too.
Yes, leaving a legacy is important for many, but if retirees withdraw funds without a strategy, they might inadvertently reduce what they can pass on to their heirs. It's kind of a double-edged sword.
Right, so finding that balance between enjoying retirement now and also thinking ahead is key.
Exactly. And let's not forget the emotional side of financial security. A lot of people underestimate the stress that comes from financial uncertainty in retirement. Having a clear withdrawal strategy can provide peace of mind.
That's so true. Knowing that you've got a plan in place can take a huge weight off someone's shoulders.
Yes. And when you're feeling secure, you can truly enjoy your retirement. A couple I worked with, let's call them Sarah and Mark, found that once they established a clear and tax-efficient withdrawal strategy, they were able to travel and spend time with family without that constant worry.
That sounds wonderful. It really shows how having a plan can change everything.
It does, and that's why I'm so passionate about helping people navigate these waters. With the current economic trends, it's more important than ever to have a strategy that not only meets today's needs, but also anticipates future challenges.
So what's the next step? How do we start implementing these tax-efficient withdrawal strategies?
Well, let's dive into some core strategies that can help folks make the most of their retirement savings while navigating taxes effectively. So Emily, when we talk about tax-efficient withdrawal strategies, one of the first things that usually comes up is the importance of understanding your different types of accounts, right?
Absolutely, David. You've got your taxable accounts, tax-deferred accounts like 401k and traditional IRAs, and then, of course, you have tax-free accounts like Roth IRAs. It's crucial to know how each of these works when you're planning your withdrawals.
Exactly. For instance, withdrawals from a traditional IRA or 401k are taxed as ordinary income. So if someone is in a higher tax bracket during retirement, those withdrawals can really eat into their savings.
Right, and that's where the timing of your withdrawals becomes key. Many people will start with taxable accounts, then move on to tax-deferred ones before tapping into their Roth accounts.
That's a solid strategy. By doing that, you're allowing your tax-free money to grow longer, which can be a game changer over time. Plus, you want to consider your required minimum distributions, or RMDs, when planning.
Good point. RMDs kick in at age 72, and they can significantly impact your tax situation. If you're not careful, you could end up pushed into a higher tax bracket, just because you have to withdraw those funds.
Right, so let's say you have a mix of accounts. You could withdraw just enough from your taxable account to cover your living expenses, thereby keeping your traditional accounts untouched for a bit longer.
Exactly, and that way, you're managing your taxable income effectively. Speaking of living expenses, let's talk about the 4% rule.
The 4% rule. It's a classic guideline for retirement withdrawals. The idea is that if you withdraw about 4% of your retirement savings each year, you should be able to sustain your portfolio for 30 years without running out of money.
Sure, but it's not a one-size-fits-all approach, right? Depending on market conditions and your personal spending needs, 4% might be too aggressive or too conservative.
Definitely. If you're in a volatile market, or if you expect to spend more in the early years of retirement, you might want to adjust that percentage. A lot of folks find success with a bucket strategy as an alternative.
Oh, I love the bucket strategy. It's pretty straightforward. You divide your assets into different buckets based on when you'll need the money.
Right, so you might have one bucket for immediate needs, like cash and short-term bonds, another for midterm needs, and then a long-term bucket that's invested more aggressively in stocks.
That way, you're buffered against market fluctuations for your immediate needs while still allowing for growth in your long-term investments.
Exactly. And if the market takes a downturn, you're less likely to be forced to sell your long-term investments at a loss just to meet your short-term needs.
I think that's a huge relief for a lot of retirees. Now let's touch a bit on Social Security. Timing your Social Security benefits can also have a big impact on your overall tax situation.
Absolutely, Emily. The age you choose to start taking Social Security benefits can affect not only the size of your monthly check, but also your tax implications.
Right. If you start taking it early at age 62, you'll get a reduced benefit. But if you wait until your full retirement age, or even until age 70, your monthly benefit increases significantly.
And that can be quite helpful if you have other income sources. If you can hold off on taking Social Security while you withdraw from other accounts, you might keep your tax bracket lower in those earlier years.
Yes, and it's important to remember that up to 85% of your Social Security benefits can be taxable if your income exceeds certain thresholds.
That's a key point. So managing your withdrawals to stay below those thresholds can help maximize the tax efficiency of your benefits.
Now, let's say someone has a mix of real estate and investments. How should they approach withdrawals in that scenario?
Great question. If you have rental properties, for example, you might have cash flow coming in from those. It could be beneficial to rely on that income before pulling from your investment accounts.
And that way, you're allowing your investments to grow. But if you need a lump sum for a big expense, selling a property can have tax implications as well.
Right. Capital gains tax comes into play if you sell a property for more than your basis. So it's a balancing act, really.
Speaking of balancing acts, let's talk about asset allocation. A well-diversified portfolio can help you weather market fluctuations, which is especially important as you start to withdraw funds.
Exactly. A common rule of thumb is the 70/30 portfolio, 70% in stocks and 30% in bonds. But this really depends on your risk tolerance and time horizon.
For sure. As you get closer to retirement, you might want to shift that allocation to be more conservative. It's all about finding what works for you.
And don't forget about tax savings techniques, like tax loss harvesting. If you have some investments that are underperforming, you can sell those at a loss to offset gains elsewhere.
That's a smart way to manage your taxes. Plus, it keeps your portfolio diversified while also being tax efficient.
Absolutely, and it's important to review your strategy regularly. Life changes, market conditions change. Your withdrawal strategy should adapt along with them.
Yeah, staying flexible is key.
Well, now that we've covered the strategies, let's talk about some common pitfalls.
Great idea. There are definitely some traps people fall into when planning their withdrawals.
You know, Emily, one of the biggest pitfalls I see in retirement planning is the sequence of returns risk. It's like, imagine you're retired, drawing down your savings, and then the market takes a downturn right when you start withdrawing funds.
Right, that can really hurt. So how does that play out in real life?
Well, I had a client. Let's call him Bob. Bob retired in 2007, just before the financial crisis. He had a good nest egg, but he was pulling money out based on a certain plan. The market dropped significantly, and he found himself withdrawing from a shrinking portfolio.
Oh no, that sounds painful.
It was. He ended up having to adjust his lifestyle and really cut back on expenses because his portfolio was hit hard. It's a classic example of how timing can impact retirement savings, and it's crucial to consider how to manage withdrawals, especially during market volatility.
That makes a lot of sense. So how can people avoid that situation?
Diversification is key, and having a withdrawal strategy that accounts for market fluctuations. For instance, if you have a mix of investments, you can pull from different accounts depending on the market performance.
That sounds smart.
Yeah, another common mistake is ignoring taxes when planning withdrawals. I mean, a lot of folks focus on their investment returns, but forget that taxes can eat away at their income.
Absolutely. Taxes can be a huge drain.
Right? I had a couple, let's call them Jane and Tom. They were withdrawing from their traditional IRA without thinking about the tax implications. They ended up pushing themselves into a higher tax bracket, which meant they paid more in taxes than they needed to.
Ouch! So how should they have approached it differently?
Well, if they had considered a tax-efficient withdrawal strategy, like drawing from their taxable accounts first, or splitting withdrawals between tax-deferred and taxable accounts, they could have minimized their tax bill significantly.
That's a great point. It really shows how important it is to plan for taxes in retirement.
Exactly. And then there's the issue of underestimating healthcare costs and longevity. Many retirees don't fully grasp how much they'll need for healthcare as they age.
That's a big one, isn't it?
Definitely. I remember working with a client named Susan. She thought her Medicare coverage would cover all her healthcare needs, but she didn't account for out-of-pocket expenses, long-term care, or even the potential need for assisted living down the road.
Wow, that must have been a wake-up call for her.
It really was. She ended up needing to make some tough decisions about her budget. If she had planned for those potential costs earlier, she could have set aside funds specifically for healthcare.
So it's not just about the day-to-day expenses.
Exactly. It's about looking at the bigger picture. And another common mistake I see is poor asset allocation. Many retirees stick with the same investments they had during their working years, which might not be suitable for their retirement phase.
Right. They might be taking on too much risk or not enough.
Exactly. I once had a client, let's call him Frank, who was still heavily invested in high-risk stocks. He thought he could ride out the ups and downs because he had many years ahead of him. But the reality is, when you're retired, you need more stability.
That's so true.
Yeah, and it's important to strike that balance between growth and preservation. Allocating assets to reduce risk can be key to ensuring your money lasts.
So it's all about finding that sweet spot.
Absolutely. And then there's the issue of claiming Social Security too early. I mean, many people are eager to start taking benefits right at age 62, but that can lead to leaving a lot of money on the table.
I've heard about that.
Yeah, I had a couple, Lisa and Mark, who claimed early because they were concerned about their cash flow. But they didn't realize that by waiting just a few years, they could significantly increase their monthly benefit.
So it's really about weighing your options and understanding the long-term impact.
Exactly. Waiting can mean a higher payout later on, which can make a huge difference in overall retirement income.
And it sounds like a lot of these pitfalls could be spotted early if people just took the time to plan properly.
Yes, early detection is crucial. Red flags can include not having a comprehensive financial plan, not reviewing your portfolio regularly, or not adjusting your withdrawal strategy as needed.
Those are great points.
And if you find yourself in a situation where you've made one of these mistakes, it's not too late to make adjustments.
So what can folks do to recover or avoid these common pitfalls?
Well, first, get a clear understanding of your retirement income sources. Consider all aspects, including Social Security, pensions, and investments. Then, work with a financial advisor to create a tailored withdrawal strategy that accounts for taxes and market conditions.
That sounds like a solid plan.
Exactly. And don't forget to regularly review your healthcare needs and adjust your asset allocation as you age. It's all about being proactive rather than reactive.
Great advice, David. It really highlights the importance of planning ahead and staying informed.
Absolutely, Emily. It's all about setting yourself up for a comfortable and secure retirement.
Well, I think we've covered a lot of ground here today, David.
Yes, we have.
And I hope our listeners feel more empowered to tackle their retirement plans with confidence.
Definitely. It's all about taking those steps to make informed decisions.
Let's transition into what our listeners can do next to keep this momentum going.
Sounds good. All right, so let's dive into some immediate steps you can take to improve your tax-efficient withdrawal strategy.
Yeah, I think that's really important. What's a good first step for someone just starting out?
Well, one of the simplest things you can do is to review your current portfolio. Like, really take a good look at it. Are you aware of how your assets are allocated?
Right, because understanding where your investments are can help you make better decisions about withdrawals.
Exactly. So I recommend sitting down with a retirement calculator. You can find great tools on sites like Vanguard, Fidelity, or Schwab. They have user-friendly calculators that help you project your retirement income based on different withdrawal strategies.
Oh, those are super handy. I know Vanguard has a tool that shows how long your money might last, right?
Yep, and it can even factor in things like taxes and inflation. It's a great way to visualize your plan, and it can help you identify any gaps you might have.
What about Social Security? Is there a good resource for that?
Absolutely. The Social Security Administration's website, ssa.gov, is the best place to go. They have calculators that can help you determine your benefit amounts and the best time to claim, which is crucial for tax strategies.
That's key, right? Timing your Social Security can really impact your overall tax situation.
For sure, and when we're talking about taxes, don't forget to consider tax software like TurboTax or H&R Block. They provide insights into how withdrawals might affect your tax bracket.
And they can help with tax planning for the upcoming year as well.
Exactly. It's a good habit to run those projections at least once a year, especially as your financial situation changes.
Speaking of habits, are there any small daily or weekly practices you'd recommend?
Definitely. Start by reviewing your portfolio quarterly. Just set aside an hour every few months. This helps you stay on track and make adjustments if necessary.
And it doesn't have to be overwhelming, right? Just a quick check-in to see if you're meeting your goals.
Right. And if you're feeling ambitious, you could even consider reading some books or listening to podcasts focused on retirement planning.
Oh, any recommendations you love?
Sure. The Bogleheads' Guide to Retirement Planning is a classic. It offers practical advice on investing and tax strategies. And then there's the Retirement Answer Man podcast, which has tons of actionable tips.
Those both sound great. I love how they break things down into manageable pieces.
Exactly. It's never too late to improve your plan. Even if you're already retired, you can still make adjustments to enhance your tax efficiency.
Yeah, like if you're in a lower tax bracket now, you might want to consider converting some of your traditional IRA to a Roth IRA.
Exactly. That's a great example. And that can really help with long-term tax planning. Just keep in mind, there are nuances to that strategy, so it's always best to consult with a financial advisor.
Absolutely. Having that professional guidance can really help you navigate the complexities.
And don't forget about financial planning apps. Tools like Personal Capital or Mint can help you track your spending and investments. Plus, they give you a big picture view of your financial health.
Those apps can really make a difference. Keeping everything in one place makes it so much easier to manage.
And as you're getting more comfortable with your plan, don't hesitate to run different scenarios. Play around with how different withdrawal strategies would impact your overall retirement.
That's a smart way to get a sense of what works best for you.
Exactly. And always remember, small steps can lead to big changes over time.
I love that mindset. It makes the whole process feel less daunting.
For sure. So those are some practical first steps. Now, let's bring this all together. So, as we wrap up, I think we've covered some really important points about tax-efficient withdrawal strategies.
Absolutely. I mean, one of the key takeaways is definitely understanding the different types of accounts you have, right?
Exactly. Like knowing which accounts are tax-deferred versus taxable can really help in minimizing your tax burden.
And then there's the importance of timing your withdrawals. Like, not just when, but how that can impact your overall tax situation.
Yes, and let's not forget about the strategy of balancing your withdrawals to manage your income levels effectively. That can make a huge difference.
Right. And having a flexible plan, adjusting as needed based on your lifestyle and financial needs. It's all about being proactive, isn't it?
For sure. It's not just about making withdrawals. It's about doing it smartly to protect your retirement wealth.
And that's so empowering. Knowing you're in control of your finances can really ease that retirement transition.
Absolutely. So for our listeners, remember, building and protecting your retirement wealth is a journey, not a destination. Stay engaged, stay informed.
And if you found value in today's discussion, please take a moment to like this episode, subscribe to our channel, and comment below with your biggest takeaway or any questions you might have.
And if you know someone who's planning for retirement or already in it, share this episode with them. The more, the merrier.
Yes, we want to spread this knowledge and help as many people as we can.
And next time, we'll dive into a fascinating topic: how to generate passive income from real estate.
That's going to be exciting, so stay tuned for that.
Thanks for joining us today, everyone.
Take care, and we'll see you next time.